In terms of new products, we have a healthy pipeline and continue to see a strong traction for our customers in both our businesses to support the future growth plans. Now let me take you through the financial performance. Revenue for the quarter was 469 crores, registering a year-on-year growth of 26%. Our EBITDA came at rupees 91 crores, which is a growth of 30%. EBITDA margin saw an improvement of 62 basis points to 19.4% as compared to 18.8% in Q2 of last year. Lastly, our PAT for the quarter stood at 44 crores, which is a marked improvement of 63% from 27 crores for the same period last year. Similarly, the corresponding figures for H1FY22 have shown immense promise. With our revenue standing at 926 crores for the first half as compared to 725 crores for H1 of last year, registering a growth of 28%. On the EBITDA front, the growth stood at 53%, rising from 122 crores to 187 crores for the corresponding period. While the improved tax rate due to opting for the new tax regime and improving finance costs led to substantial increase in profit after tax with a growth of 125%, rising from rupees 42 crores in H1FY21 to rupees 95 crores in H1FY22. The company's cost of financing has also reduced as a result of efficient working capital utilization and successful renegotiation of lower rates of interest, which augurs well for our company and the benefits will continue to accrue going forward. Our pharmaceutical division maintained similar revenue levels for the quarter as last year. At 280 crores, the Q2 revenue for the division was flat as compared to the same period last year. The EBIT for the division came at rupees 37 crores, which translates to an EBIT margin of 13.4%. For H1FY22, with a revenue of 554 crores, the division registered a growth of 12% year-on-year. In terms of EBIT, the growth was at 20%, rising to 86 crores on a year-on-year basis. This translates to an EBIT margin of 15.5%. This quarter, last quarter in Q2, we received the manufacturing license for production of APIs at our Panoli site. This is in line with our strategy to diversify our manufacturing footprint by having two independent sites to manufacture APIs. Over the next several months, we will be validating several APIs for launch in the next financial year from our Panoli site. Our crop protection revenue for Q2 was 190 crores, which is a year-on-year growth of 105%. The EBIT for the division was 34 crores compared to 8 crores in Q2 FY21, which is a growth of 335% year-on-year. The EBIT margin is 18% in Q2 FY22 compared to 8.5% in Q2 FY21. In H1 FY22, rupees 372 crores revenues were recorded, registering a 61% growth on a year-on-year basis. The EBIT stood at 66 crores, an increase of 167% on a year-on-year basis with margins of 17.7%. During the last quarter, historic rainfalls in the Raigad district region had a severe impact on our Mahad operations, leading to the shutdown of our Mahad facility for almost a month. This led to a loss in sales and profitability for the division. Relentless efforts by our teams from all our sites helped in restarting our operations in a staggered manner, and we were able to return to normal operations in due course. Despite the challenges faced by the flooding, our crop protection division did well to recover last quarter. Global supply chain challenges coupled with steep increase in input raw material prices continue to pose a challenge for our industry going forward. We were hit by the disruption in logistics in the past few months and more recently are experiencing an unprecedented increase and non-availability on input raw materials. We have put in significant efforts over the past few years on developing alternate sourcing partners and backward integration of certain raw materials. While this will help us in the medium term, we do expect certain disruptions in the short and near term. Over the next several months, we do expect the situation to normalize. We have commissioned new capacity for our pharma CDMO business in our Unit 2 facility in Bangalore. This is primarily for our development pipeline in our CDMO business. CAPEX investments for multi-purpose facilities is on track across both our businesses for new products to be launched in a staggered manner over the next several quarters. We expect to complete several ongoing revenue and infrastructure projects by the second half of this year and going into next financial year. We are undergoing a transformation of our business from good to great while continuing to drive profitable growth. As I informed you on our last quarterly call, we have onboarded a global consultant to help us identify the right strategic direction for choosing suitable products, partners, and technology for the future while bolstering our R&D and manufacturing capabilities. In addition to this, our business excellence initiatives continue to benefit the organization by increasing operational efficiencies. Our transformation exercise is underway, and we expect to reap the benefits over the next several quarters. We are receiving traction in our animal health business post the signing of a long-term contract several months ago. We believe firmly that the journey forward will entail further accelerated growth for our existing as well as emerging businesses. While the number of products in the pipeline and the customer inquiries have increased, a healthy list of leads and inquiries for new businesses, the company is well positioned to capitalize on the opportunities at hand and those which will come going forward. This growth hinges on multiple drivers, starting with our ability to convert numerous inquiries which are increasing quarter on quarter from the top global players into concrete businesses backed by a global shift in strategy of creating an alternative to China. By focusing on our core strengths of developing our own processes and technology and delivering the best-in-class products, thereby becoming a partner of choice for our customers. In terms of an outlook for the year, we stand by our initial projected growth in top line at a CAGR of high teens, along with an improvement of 50 to 100 basis points improvement in EBITDA margins per annum over the next 2 to 3 years going forward. The growth trajectory, along with new opportunities, strong customer relationships, and new technologies, will catalyze our progress towards our bold aspirations. With this, we will now open the floor to question and answers. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to limit a question to 2 per participant. If time permits, you may join the queue for any follow-up. Ladies and gentlemen, we will wait for a moment while the question queue assembles. First question is from the line of Rohit Nagraj from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity and congrats on a decent set of numbers despite the challenging environment during the quarter. So the first question is the lost revenues because of Mahad plant shutdown. Is there any possibility of recovering them in subsequent quarter? And because of the non-availability of some of the raw materials, do we further expect that the revenues for the next Q3 and Q4 may get impacted? Thank you.
Yeah, thanks for that question. The first question was regarding the Mahad facility impact and whether we'll be able to make it up. Well, the efforts are underway to ramp up capacity. We are trying to make up to the best extent possible, but there is going to be some impact because the shutdown, as you know, was almost a month. So we're trying to minimize the impact for the remaining 2 quarters. And the second question I think you asked was regarding what is the impact on raw materials on the future prospect of the business. Well, raw material prices are going up, input prices have risen, and they've risen quite dramatically. We are trying to pass on the benefits, the price increases to our customers. Obviously, there's a lag effect in many cases, but these are efforts underway. There's a lot of uncertainty in the market today, and not only in pricing, but also in terms of availability. But we are quite hopeful that with the mitigation plan that we put in place over the last several years, we'll be able to ride the storm and be able to minimize the negative impact of the increases. But it is a challenging time, and raw material shortages, energy costs are all increasing, and input prices are increasing.
Sure, thanks. So the second question is on Hikal 2.0. So last time you had indicated about the initiative. So any tangible and material benefits that have accrued over the last 1 year, and how are we seeing the benefits accruing maybe over the next 1 year or 2 years time frame? Thank you.
I'll hand it over to our transformation head, Anish Swadi. Anish, you can take that?
Yeah. Thanks, Samir. So as you know, we just started this exercise a few months ago. It's not been on for a full year. It's only been a few months since we started, and we're starting with the strategies of both the business to redefine and to validate what our current strategies are in place. I think the tangible benefits will happen over a period of time as we implement some of the initiatives that have been recommended by the teams. So that will happen over the next several quarters, right? Starting off slowly and then ramping up as we implement it. As you know, our business takes a long time to implement several changes, whether it's regulatory, whether it's manufacturing. But certainly the initial impact has been positive, and we do expect these benefits to accrue over a period of time.
Yeah, thank you so much and best of luck.
Thank you. Our next question is from the line of Dhruv Bhimrajka from Monarch AIF. Please go ahead.
Yeah. Sir, my question is that in your 4Q21 press release, you had mentioned about a new long-term contract of a fungicide with a US-based crop protection company. So any update on that long-term contract, sir?
Yeah, but that's ongoing. That's under execution. It's on track. There's no change since the last board meeting. It's underway.
Okay, so as and when it happens, that will be announced. So it is under the agreement stage right now, is what we can assume.
No, it is signed. It's already signed.
Okay.
Execution is underway right now.
Okay, execution is underway.
Yes.
Okay, that's great to hear. And also, sir, in your latest in your 1Q22 press release, you had mentioned about emerging business verticals such as animal health and biocides. So can you please explain what is this biocides? Because I'm new for this company, so just wanted to understand the biocides business.
Yeah, hi, this is Anish. So the biocide business lies under the specialty chemicals umbrella. The beauty of the biocide business is that basically we utilize our own crop protection assets to manufacture these products. So we have several biocides that go into various aspects. So for example, we have biocides that go into the paint industry that can also be used as crop protection products. So they're multi-purpose dual-use products. We've been in the biocide business for several years. However, now we've got a strategic plan to accelerate the growth of that biocide business. There are supply chain constraints coming out from China, and we think this is a good advantage or a good place for us to take advantage of and utilize our chemistry skills as well as our customer outreach to grow this type of business.
Okay. Thank you so much, sir. I'll come back in there.
Thank you. Before we take the next question, I'd like to remind our participants to limit their question to 2 per participant. Thank you. The next question is from the line of Ranveer Singh from Sunidhi Securities. Please go ahead.
Yeah, thanks for taking my question. Sir, on CapEx side, what CapEx we have spent in first half and what is planned for second half for next year also, if you could give?
Hand over to our CFO. Kuldeep, if you can take that question, please.
Sure. Thank you. So far, in the first half, we have capitalized almost 127 crore rupees expenditure, and we expect almost 175 crore in the next H2.
And for FY23, sir?
FY23, we are estimating close to 300 crore.
Okay. And any target for debt reduction for next 2 or 3 years?
No, we are into the capex expenditure mode, so we cannot really look at that as a target. But we will just like to maintain our debt equity on the same ratio.
Okay.
And you know, like we have observed also, our interest cost is coming down.
Yeah.
And debt equity is also coming down.
Okay. And just I missed your comment on status of Mahad facility. So this has resumed operations now?
Yes, it did resume. It was shut for almost a month, but resumed operations.
Okay. Thanks. That's it from my side.
Thank you.
Thank you. The next question is from the line of Ashish Thakkar from Motilal Oswal AMC. Please go ahead.
Yeah, thanks for the opportunity. So can you quantify the impact of logistics and higher energy consumption? So what was the cost impact in this quarter?
Logistics impact on this quarter was around 2 crores was the impact for this quarter, and energy consumption was around close to 4.5 to 5 crores.
Okay. You feel this energy consumption, this could get addressed for the next 2 quarters, because some of the companies were mentioning that these costs could normalize over the next 2 quarters?
Yeah, we're hoping, but let's see. It's a wait and watch. Again, many of our contracts, as I mentioned earlier, are passed through to our customers. So there could be a lag effect, so to normalize the pricing as well.
Okay. So, but on this pass-through contract, are other customers willing to take the impact, the full impact in one go, or you are passing it on in a staggered manner?
I mean, it depends. It's more or less it's staggered manner. Everybody's input costs are going up, so we have to share the pain sometimes with our customers and share the benefits also. It's a partnership model. Yeah.
Okay. So one last question on this.
Yeah,
got that. Yeah, thanks. So a question on this capex, around 400 to 500 crore capex that we have lined up over the next 2 years or so. Any asset plans you guys are working on? What's in your mind?
I'm sorry, can you repeat that? I couldn't hear you. What is that?
So roughly around 300 to 400 crores in capex that you would be spending over the next 24 months. Is there any asset turn guidance that you'd like to give to the investors?
Yeah, we've been maintaining an asset turn ratio about 1.5:1, and we still maintain that.
Okay. And if I have some more questions, I'll get back to you. Thanks.
Thank you.
Thank you. The next question is from the line of Sandeep from East Lane Capital. Please go ahead.
Yeah, hi. I have 2 questions. The first question is more medium term. If you look at your pharmaceutical CDMO business, it is about $60 million. So given the opportunity, given the pipeline you see, what is the potential for this business? The largest players, DV is at about $370, $380 million today. So from 60 million, where can we be in 3 to 4 years? And what are the requirements for us to really scale this business?
Well, you're right. I mean, there is a lot of potential to grow the CDMO business, and we're seeing a lot of new inquiries coming in the CDMO business. So we're quite confident of growing this aggressively. It takes time, as you know, to acquire a customer. A customer tries you out with one project, and it takes time to ramp up. You mentioned a company in your question. It's also taken them 10, 15 years for an inflection point to change. We're well on our way on that journey. We expect the business to grow over 2 to 3 times over the next 2 years as we go ahead.
Understood. The second question is that if you look at your margins for pharmaceuticals, and which is like 50-50 CDMO and own products at this point in time, again, margins are subpar when we compare you to some of the more scaled players. What could be the reason for that, and how do we see the margin trajectory going forward? I understand the current quarter because of logistics, raw material, etc. And if we take that aside, what are the right margins for this business? Is it that you have to take the technology from your MNC partners and that's why the margins are lower? Or some of the products like gabapentin, you have 35% market share, but not reflected in margin. So just how to think about margins in the medium term?
Well, we're refreshing our product portfolio by launching new products over the next few years. Every year we're launching new molecules at a much higher margin ratio. So while some of the current historical margins are due to the older products and due to competition, but going forward as we take on any new molecule and we launch them, the margin profile is very different. It's well in excess of what we have. So the margins will start improving year on year. I think this H1, a lot of the impact was due to the input prices going up. That was and logistics costs. Otherwise, I think margins will start once things stabilize. We are quite, optimistic that margins will start going up on the pharma business.
And last question is the crop protection margin generally lower than pharma margin or nothing like that? It's product to product.
Well, depends on what product you choose and what profile. I mean, if you have generally pharma is higher than crop, but if crop will also be high in certain cases. It's a case-to-case basis. I don't think I can generalize. If you do niche product in crop, which we are doing, a lot of our molecules on the niche side, we have a good margin on that. We're not doing commodity bulk products in crop, and that's why we have our margins are quite reasonable in the crop business.
Fair enough. Thank you so much.
Thank you. The next question is on the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. Sir, first question on the global consultant and, wherein we are trying to identify and growth opportunities. So two parts to the question. One, are we or is this consultancy arrangement largely to restructure or improve the efficiency of the current business segment, or it is also expanding into adjacencies and maybe a newer segment, from a growth perspective?
Yeah. So the strategic exercise or the transformation exercise that we're taking is across the company. It's looking at ESG, which is a core strategy of ours. We're looking at key account management. We're looking at how to be the best in class when it comes to manufacturing, R&D, and also looking at new diversified strategic areas for our business. So it's across various aspects of the company. It's not only focusing on a particular segment of business. We are evaluating new areas based on new technologies that we can incorporate or inculcate within the company, and how to pivot from there and build on those new verticals. So it's not a restructuring, but it's a transformation, because we already have a very strong base built. Now, how do we pivot from the current base into the next orbit?
Sure. And, if I look at our pharma revenues or even the crop protection revenues over the last maybe 3 years, more or less we have been in a tight band. So just wanted your thoughts on the product, ramp up or the revenue ramp up for the product. Whether the growth will be largely led by the new product launches as well as the CDMO opportunity, or is there a like-to-like growth delta in the products as well? And if you may, add on to the overall growth potential that we are looking at in these two segments.
So on the product side, look, we have a existing large base volume business, and this business is growing as well, right? The key to this business we're finding is that over a period of time that we've established ourselves as a global leader in most of the products that we manufacture, and they are margin accretive. I think the incremental or the delta margin will come from new products that we've got in the pipeline under both the businesses. We are launching several products in the next several quarters. We have a strategy to launch at least 2 to 3 new products in the crop protection business and 3 to 4 in the pharma business. And we also have a healthy pipeline of CDMO projects in both our businesses. So with these new products coming on stream, the margin profile will increase. We'll see a delta there, and that's why we give our future guidance of increasing our EBITDA margins over 50 to 100 basis points. I'd also like to say, in addition to that, it's just because we do have an old base of products, we're also increasing the margin efficiency wherever possible there. We work on processes continuously. We have cost improvement programs across the company for some of the larger, older volume products that we do have. And since we've established ourselves, we are keen to maintain that leadership position, and we will maintain that leadership position in those older molecules, which are actually coming back and still increasing in terms of volume.
That's helpful. And if I may just squeeze in one more, with this, growth opportunity across CDMO as well as the new product segments, will it also change the working capital profile of the company? Historically, we have been having, slightly higher inventory days. We saw some reduction last year, but is that reduction sustainable, or will probably bounce back to the same 150, 160 odd days on the inventory side?
Yeah, absolutely right. In terms of the number of days, it will remain same. But in terms of the absolute value, it will increase in the proportion of the business.
So, sir, when you say same, it is 150 days or 110 odd days in last year?
It's 110 days currently, which will try to maintain at 110 days.
Okay, that's helpful. That's it from my side. Thank you and all the best.
Thank you. Our next question is from the line of Aditya Khemka from InCred AMC. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, a question on other expenses. So you mentioned that power and fuel costs are going up and it is impacting cost of operations. But if I look at your other expenses for the first quarter and the second quarter, the numbers seem to have gone up year over year by 30 to 35% between the two quarters. And, generally power and fuel is half of our other expenses, broadly speaking. So assuming that, your power expenses have also gone up 30-35% year over year, how much of this is driven by volume in terms of volume of production, and how much is the tariff increase that you're paying?
Since our total expenditure, over 60% is towards the volume, and the balance is because since last year we were having a pandemic, these are not really comparable.
Mm-hmm. So I understand volumes may not be comparable, but in terms of tariffs?
In terms of?
Tariff, cost of power?
Yeah, cost of power certainly has gone up. So which is 60% towards the volume and 40% towards the cost.
40% is towards the cost. Okay. And if I look at your crop protection business, in that business, basically, we saw a very rough patch in previous years, and now for the last 3-4 years, we have been in the 600 to 700 crore sort of top line range. And I understand you are launching new products, but I want to understand the base business better. So whatever growth we have seen this first half of FY22, how much is it driven by pricing and how much it is driven by volume? Any color on that?
Well, if you look at our revenue for the first half, our crop business revenues grew by over 60% in terms of value terms compared to last year. Because the last second quarter was actually not a comparable quarter. There was a pandemic and we had some other issues on our side. This year, in spite of having the Mahad flood issue, we've been able to increase volumes by 29% compared to the last half year. So value is growing faster than volume. We have launched higher value, higher margin products, and we're very cognizant of the fact on pricing and volume margins. So our value is overtaking our volume increase.
Got it. So one question on this: what is the nature of the business here? So you may launch higher value products, but are these products where you have limited competition or no competitors? And if more competitors were to emerge, could there be pricing pressure on these kind of high value products?
Well, almost 70%, 75% of our crop protection business is in custom manufacturing. Compared to 50% on the pharma side. So the custom manufacturing space on the crop side, we have long-term contracts for on-patent molecules. Now in on-patent there is no competition. Even if it goes off patent, 80% of the crop protection industry, 80 to 85% of crop protection industry is on patent or proprietary off patent. That means there is no competition even when it goes off generics, because our customers have innovative formulations which they patent. So the competition is very limited. If competition do come in, we see the big 5 or big 6 agro companies that we work with are able to retain maximum market share, unlike the pharma industry, where the generics make a very big dent. In the crop industry, generics contribute to less than 20% of the total crop segment, and that is expected to remain, as the innovator companies in the crop business will defend their market share and their products even when they go off patent.
And this less than 20% you're saying is in terms of volume, not value?
In terms of value. Volume is much higher. Generic value, volume will be much higher. I'm talking in terms of value.
In terms of value. Okay. Yeah. Understood. Got it. So generally, when a generic... So generally when a generic launches a product after it goes off patent, what is the kind of price discount they offer?
It depends on a case to case. We have a very few generic products that we compete on the crop side. We're mostly on the innovator side, on patent side, or proprietary opt. But there is some pricing pressure, but it's not as steep as the pharma business, where there's a drastic fall. Crop is far more, gradual, because there is less competition on the generic side, and there are only 2-3 large players on the global scale that participate in any generic portfolio.
Right. Got you. So sorry, I would butt in with one more question. Mahad as a site has seen several bouts and episodes of flooding and several black swan events, quote unquote. And our crop protection business seems to be heavily reliant on that site. How do we manage this risk of natural disaster as a company?
Well, I don't think there have been several black swan events. There was one event, but that's impacted once in 50 years. So I would not like to put that down to anything to do with our site. It has impacted the entire region. That being said, our Mahad business contributes to less than 20% of our total crop protection business. We are de-risking our other sites. We are expanding capacity at Panoli site. So Mahad will remain an important part of our crop business, but we'll have options at Taloja and in Panoli. And we're also putting in place measures in case such an incident does take place in the future. We have safety measures in place to prevent any such disaster taking place on our sites.
Thank you for the answer, sir. All the best.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in conference, please limit a question to 2 per participant. If time permits, you may join the queue for follow-up. The next question is from the line of Pranay Delia from Panchatantra Advisors. Please go ahead.
Hello, Samir. Many congratulations on another great set of numbers. We continue to stay invested and hope the company continues to grow as well.
Yes, thank you.
Just 2 quick questions. What was our capacity utilization in this quarter?
You have one more question, or you answer both, Himanshu?
One is on the capacity utilization, and second is on the debt. You can give me details of the debt outstanding.
Sure. On the capacity, I'll take it, and debt I'll hand over to my CFO. Capacity, we have around 85% utilization on capacity. And debt, Kuldeep, if you can please answer the question related to debt.
Sure. So our debt as on 30th September remains 629 crore, which was 616 crore as on March. This includes primarily 225 crore for the working capital and 400 crore for the long-term loans.
Can you give me a breakup of the capacity utilization in terms of pharma and crop protection both, please?
They're both in the 80 to 90% range. I mean, all our plants, that's the reason we're going for new capex, because we're running out of capacity and we're putting in place. So they're running between 80 and 90%.
Okay. And the domestic export breakup of our sales? And the domestic and export breakup of our sales?
Domestic and export is about 70-30. 70 is export and 30 is domestic. But most of the domestic business also is deemed export.
Pharma and crop both?
Crop is slightly lower in terms of domestic, which is about less than 20%. Pharma is slightly higher because a lot of our customers are in India which formulate, but those are taken as deemed export sales for domestic sales.
Okay. That would be from my side. Thank you once again and many congratulations. We will definitely be much better in the quarters to come.
Thank you.
Thank you. Our next question is from the line of Anubhav Sahu from MC Research. Please go ahead. Anubhav, your line is unmuted. Please unmute your line and proceed.
Yeah, sorry. So, thanks for the opportunity. Well, my question is mainly with respect to your mega capex cycles. So you mentioned around 180 CR you would be spending next 2, and I think 300 for next year. So my first question is how long and how big is the capex cycle going to be? And if you can elaborate various milestones for that.
Yeah. So I think my CFO would answer it, but I'll repeat that. You're right. We are spending about 175 crores in the remaining part of this year. And as mentioned, we are spending around 300 crores next financial year. Now, it takes typically 12 to 18 months to post-launch on the pharma side to start realizing the potential of the capex. On the crop side, you can start realizing this faster. But that's the typical. So if we're doing the capex, let's say by end of this year, whatever we do by end of this year, we start realizing by end of next year, and then gradually ramp up over the next year or so. So the benefits will start coming in from FY24 onwards. That the big benefits will start coming in.
Okay, if you could, categorize in terms of both pharma and crop protection, how is the incremental capacity would be after the end of this capex cycle?
By the end of this year, the pharma and crop protection will be around 60-40, 60 pharma and 40 crop. And we expect that to move towards a 50-50 split by the end of FY23. In 23, we expect to put in more capex on the crop side as we are acquiring new crop protection projects. The pharma will be more or less completed this cycle by end of this financial year. And then next year we'll be investing more on the crop side. So if you take a 2-year average, it'll move towards a 50-50 split this year and next year.
Okay, that's on the sales side. So what I meant is because of your investment for next, including this year, for 2 years, 600 CR kind of investment you're looking at. So what is the incremental capacity which we will be having for both these segments, both for crop protection and pharma?
Well, these are multi-purpose large plants being put in. They will add an asset turn of typically 1.5:1. So if you put in 300 every year, so you multiply that by 1.5, that's the revenue generation potential on these capexes at peak, which will take a few years post commissioning of the plant to realize.
Okay. And my last bit is that for next fiscal year, though I understand that for fiscal year 24, probably major benefit will accrue to us, but for fiscal year 23, how do we see the incremental capacity addition for us?
Well, most of the capex is underway. Half has been done till now, half has been done by end of this year. So FY23 will be the year we're validating the product, we're launching the molecules. It takes time to do the filings. So there will be some impact on FY23, but the bigger impact will come on FY24 onwards. And then the capacity will go up considerably.
Got it. I think it's quite clear. Yeah. Thanks a lot for this. Thank you.
Thank you. The next question is from the line of Nilesh Joshi from Trendlyne Capital. Please go ahead.
Yeah. Samir, thank you for taking my question. To one of the question on CDMO business, which is currently, as you said, about $60 million US. You said that you would like to grow this business by 2 to 3 times over the next 2 years. Is that correct understanding? Hello?
Maybe it'll go by 2 to 3 times over the next 4 to 5 years. I don't think it was 3 years. It will grow rapidly, but it will take about 4 to 5 years to get there.
Okay. And then do we have enough capacity in place for that?
So we're investing. This is part of the capacity we're investing is towards the CDMO business. In Q2, the capex that we had capitalized was a new CDMO plant that we had built. And the balance capex that we're also doing, a lot of it is towards the CDMO business that we're putting in place. These are all multi-purpose assets, so we can do CDMO.
So that would come in by next year?
Some of it will come in towards the end of next year, but the benefits will start accruing from FY24 onwards. It takes about 12 months to start post-filing, validation batches, putting them on the filings. It takes about 12 months after the commissioning of the plant.
Okay. The second question is on that animal healthcare, which we signed a JV agreement. What is the status, if you can spend some more details onto it?
Well, on the animal healthcare part, the project is in 2 parts. First is the R&D development of the molecules, which is currently underway and is progressing very nicely on track. And now we're moving into the second phase of the project. We're starting to design the plant, and we will be starting to construct the plant in the next financial year.
So it would come in operation when FY24?
That's correct. This is a long-term project. It's a long-term contract, as you know, we've signed. The first phase is to develop the molecules and develop the technology from scratch, which we are doing. And the second phase is to build and start manufacturing on a commercial scale.
Oh, so our understanding was that these molecules are already existing and probably the JV partner would have provided the processes to manufacture it.
Only for a few they've done that, but majority of them have to be developed by us. It's a large basket of
come under not CDMO, but it will be something similar to CRAMS, right?
Yeah, it's like CRAMS, you're right.
The third is on the Mahad, that 1 month loss of production. Can you quantify what kind of expenditure we would have incurred to restart the operation, and has it been gone through P&L in Q2 or it will come under Q3?
The expenditures are all being, as we said, we're putting an insurance claim, and that's under discussion with the insurance agencies. So we're well covered for the insurance. And as and when we accrue the insurance, then we will recognize them in our results, yeah?
But will you be able to quantify how much that could have been approximately?
Well, we're under discussions with the insurance company, so I don't think I'll be in a position to talk about that right now.
And the last is on the other expenses, since it has gone up substantially in Q2 over Q1.
Yes.
Any cost towards commissioning of this CDMO would have been accounted in this quarter, Q2?
No, it's a very small. It's mostly due to energy and logistics increases. That's the main reason.
So that you said we should start recovering from Q3 with a lag effect?
No, it's a part of it. Logistics and energy, there's a lag effect, but you can't recover all of it. You recover part of it. Yeah.
Okay.
Yeah.
Thanks. That's all.
Yeah.
Thank you. The next question is from the line of Mohit Arora from SOIC LLP. Please go ahead.
Congratulations on a great set of numbers. Sir, I had a question. Basically, in terms of a capex plan, just trying to get my own understanding right. So this year we had a capex plan of 300 crores, and even next year we have a capex plan of 300 crores. And in FY24, we'll also have the 10-year contract for the animal CDMO kicking in. Is the understanding correct?
That's correct.
Right. And sir, second question was, so our long-term guidance for growing the pharma business is like 2 to 3 times, and even the animal CDMO business is basically a top line of 500 crores. And then pharma and in agro as well, we have mentioned that we grow the revenues by almost 2 to 3x. So over the next 4 to 5 years, are we looking at Hikal basically doubling or tripling its top line?
We're looking at growing the business substantially, yeah? And as part of our transformation strategy.
That is heartening to know. And sir, one last question. So in first half of the year, we did a gross margin of close to 61%. So the impact of input cost, raw material, isn't that visible? So do we expect to maintain our gross margins in the second half of the year?
Well, input costs are definitely a concern, and that's why we still remain by our guidance of 50 to 100 basis points EBITDA for the full year compared to the last financial year. So there could be some marginal ups and downs on the margin for the quarter 3 and quarter 4, because our margin for 6 months was 20.2% EBITDA, and 100 basis points over, or 50 basis points over last year is 19.3 to 19.8%. So we remain in that range of guidance.
Right. Thank you so much, sir, and wish me all the best.
Thank you.
Thank you. The next question is from the line of Sameer Dosani from Carnelian Capital. Please go ahead.
So just to clarify one thing, so we have capex of 175 crores in H2 and 300 crores of capex in FY23. We also have 250 crores of capital working in progress, which is sitting in the balance sheet. So do we expect 475 plus 250 crores to come commission in FY23, and benefits of this would accrue in FY24? Is that what we are saying?
Part of the CWIP as on 30th September will be capitalized in the second half. That is what we are talking about, 175 crore. And this 300 crore for the next year will be capitalized somewhere in 23-24.
Okay, so this 475 crores is including the CWIP that is already in the balance sheet, right?
Right. You are right.
And this excludes our animal healthcare contract, right?
Yes, you are right.
Okay, and second clarification, so when we say 2 to 3x in CDMO business, does this include our animal healthcare contract or it does not?
Yeah.
So included, right? Already included in this one?
Yes, it is included, yes.
Okay. Yeah, thanks. That's it from my side.
Thank you. The next question is from the line of Manish Jain from Money Life Advisory Services. Please go ahead.
Yeah, thanks for the opportunity. My first question is, what kind of new opportunities are we seeing from China Plus One strategy?
Well, we're seeing new opportunities in both our business divisions, whether it is even on some of our generic products where there were the Chinese suppliers. We're seeing market share moving towards suppliers in India, including Hikal. On the CDMO side, many innovator companies were focused on China. They've decided to now focus on India, outsourcing. So we're seeing opportunities there. On the biocide side, where Anish spoke about, which is as part of our specialty chemicals business in our crop business, which is an allied business, there's a lot of opportunities to shift volumes to India. On the animal health side, a lot of the active ingredient manufacturers are primarily based in China. Again, one of the reasons why this contract we signed with a large multinational company was to de-risk the supply chain out of China. And we're seeing many more animal health companies also talking to us to further de-risk, and we had discussions with them for similar type of contracts going forward. So it's not only specific to one business, it applies to all our divisions, and all of them starting to gain from the China shift.
That's good. My second question is, what can we expect the contribution of new products to the overall revenue in the future?
It's around 10% currently, and we're looking at accelerating that to about 15%, and overall it could even go to 20% over the next 4 to 5 years, medium term.
Okay. Thank you and all the best.
Thank you. Next question is from the line of Ranveer Singh from Sunidhi Securities. Please go ahead.
Yeah, thanks for follow-up. Sir, just on the capacity we have commissioned for CDMO business at Bangalore. After this commissioning of capacity, how much total CDMO capacity has increased?
This is a new development and launch plan that we've done. So the capacity has gone up by between 15 and 20% on our CDMO side. But this is not multi-purpose capacity.
Oh, okay. So is it dedicated capacity that's well?
Sorry?
Is it dedicated capacity?
No, it's not. It's not multi-purpose. We have a lot of flexibility in our capacities. All our plants are flexible and multi-purpose.
Okay. And if you could give some quantitative factors, like in terms of number of projects currently we have in CDMO, or number of clients, or order book, if you could give some indication, that would give more visibility on this business.
Yeah. So in the pharma space, we typically have about 10 to 12 products. 7 to 8 are currently in the grants. 10 to 12 are already commercialized. 7 to 8 products are in the pipeline at various stages that we are currently in scale-up or in this active discussion mode where we're launching the molecules.
And is it possible to assign value of the pipeline projects?
These all, under clinical phase 2, phase 3 trials. So it's very difficult to give you a value potential. I mean, it all depends on how the molecule does in the market and what is the success rate. So it'd be very difficult to give a number to this.
Okay. And on anti-diabetic side, whether we'll be manufacturing gliptins for API?
Yeah, we're making gliptins and the glyphosate. We're very strong on the anti-diabetes portfolio, and that will be our next wave of products that we're launching. They go off patent in the next 4 to 5 years, and we are getting a lot of traction with our customers on these molecules.
Okay, fine. And similarly for crop protection CDM also, if you could give some pipeline projects detail.
So in the crop side, we currently have about 4 products in the CRAM side and 2 proprietary products under development. And this list is increasing as the number of inquiries are increasing. But this is as of today. If you take today's numbers, we have about 4 products in the development on the CRAM, which is CDMO, and 2 on our own development.
So growth would be coming through addition of new projects, or this pipeline or this product itself is a high volume products and will grow in volume?
In crop, these are already launched products or to be launched, and the ramp up is pretty fast. Unlike pharma, the crop launches take place much faster. So we expect them to ramp up within a few years to get to large volumes.
Okay. Thanks a lot. That's it from my side.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Mr. Samir Hirmat for closing comments. Thank you, and over to you, sir.
I would like to take this opportunity to thank everybody for joining the call. I hope we have been able to address all your queries. For any further information, kindly get in touch with the Strategic Growth Advisors, our Investor Relations Advisors. Thank you once again. Stay safe. Goodbye.
Thank you very much. Ladies and gentlemen, on behalf of Hikal Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.